the very logical point next comes to what's happening on rates, on domestic rates.
Yeah.
The previous policy was much less about rates. It was all around, this FCNR and related stuff. So probably August is the policy. The first week is probably going to be a policy where the focus is entirely going to be on what is the RBI planning to do on rates. What is their narrative? What is your expectation? And just to kind of set the context, I think increasingly I've heard a lot of people saying that August probably is a hold, and probably rate hikes are coming, but probably into October and December. This is what we hear, but wanted to understand how are you looking at this?
See, I think what we are seeing in a way, right, when when we speak to people and we look at the data points, I see a slight dichotomy on one front. On one side, there is this economist community saying that there is a certain amount of slack in the system. Most people are penciling in a 6.7 kind of a number. That's where the RBI stands for FY27.
On GDP growth.
On GDP growth. And the optimists in that space are saying that we could probably nudge 7. And around these numbers, I think the sense is, there is some bit of slack in the system, which means our actual growth can be faster without triggering concerns on inflation. So this is on one side of the spectrum. Now you look at the other side, which is really what the corporate earnings numbers are showing. This quarter, June quarter, 18% revenue growth. Expenditure growth has been significant. Despite that, your operating profits have also grown by 18%, which means that corporates have been able to pass on the price hikes.
Correct.
The input price hikes, they have been able to pass on. If that is indeed the case, it tells you that demand is quite good.
Willing to take the price hike.
Willing to take that price hike, willing to absorb it. Number two, it tells you price transmission is happening. So input or output, whichever way, inflation, it will probably nudge up. So these are not sitting with each other in a very, very comfortable manner. But be that as it may, it looks like given where we are not seeing sharp pressures showing up anywhere. The current account, if you see, last year we ended at 0.6. First quarter, we seem to be on a slight surplus.
Surplus in the first 2 months.
Yeah, so we seem to be kind of okay there. The fiscal position, yes, because of this crude and all of that, probably some bit of slippage we'll need to get.
But that's the crude aspect, I would imagine.
Yeah, and we need to get ready for a little bit of a slippage. But corporate taxes have been very good, 16% growth until middle of July, I think. So that's looking quite good as well. So I think pressures, the way the pressures show up, it's not showing up as much in all of this. Yes, bank credit is growing at 18%.
I don't think we've heard this number for a long time.
It's the highest in a decade, apparently.
Yeah.
So it is growing at 18%, and typically when bank credit grows by significantly higher than GDP growth, then it is a telltale sign that inflationary pressures are building up. But a lot of this could be on account of working capital because of supply chain, issues because of the Middle East.
Correct.
It could be because of working capital as well. So we don't know. So looking at the other indicators, this is the only one indicator which is showing that. Other indicators are all pretty much kind of okay. So if that is the case, then it gives RBI the leeway to kind of be patient for a little longer.
Correct.
As of now, your core inflation ex gold seems to be somewhere in the 2.5-3% kind of zone. And if you take that also into account,
you mean somewhere ex-gold, ex-fuel as well?
Ex-fuel and food. Core is ex-fuel and food. And if you remove gold, then it is in the 2.5 to 3% ballpark. I'm adjusting for the last 1 month or so. So therefore, in that situation, they probably want to view it as non-generalized kind of inflationary pressures. Now, of course, all of this is slightly look back kind of numbers. We'll need to see how this pans out.
But I guess incrementally, the one important factor, which is monsoons, in the last 4 weeks, if anything, it has only gotten better. So to that extent, it probably supports this line of thinking that the RBI does have some more time before they decide to kind of move on rates. So that's probably how we're going to look at it.
Yeah,
now,
maybe you want to just quickly touch on that point, that monsoon point, because we are all so used to hearing about, there's a big deficit.
Yeah, because I think I came across this about 2 weeks ago. Apparently, there is a complete change in the monsoon pattern where there's an entire monsoon line which is covering India, from India to China and Korea. And it's going to bring about a lot of rains across the plateau. So especially, parts of Uttar Pradesh, central Maharashtra, central India are likely to see better monsoons. So to that extent.
And apparently in July, the normal rain number that is expected is some 271 or 272 mm. And we have received about 270.
Which is probably
so it's significantly, like normal kind of rainfall rather than a deficit.
Yeah, so this is one important positive, I think. The last time we spoke in June, it was all fears of monsoon. It's kind of panned out quite well.